Hello students, welcome to Chakane Institution YouTube channel. Hashtag our pride is more educational. My name is Chakane Rutendo and I'm your accounting expert. So before we start, if you are new in this channel, make sure that you subscribe, share and like, and more important, turn on the notification bell. Let's get started. Today, I want us to focus on the 5 elements of accounting. So I want us to focus on 5 elements of accounting. For this episode number 1, I want us to discuss only the element called income. The element called income. So first of all, in order for you to understand accounting in and out, you need to know these 5 elements of accounting because they are skeleton of accounting, they are foundation. No house can be built without the foundation. Same apply to these 5 elements of accounting. So now, this element which is income, first of all, we must be able to understand what is an element called income. So income, we can define it as simple as income. We are referring to all monies that the company generates. All monies that the company do what? Generates. Why? Due to what? Due to operations, meaning that if you are operating as a business, you will generate what we call money. And what is that? An income to your company. So it's very much important. Each and every business, others they simply said that this is a profit. That is the main purpose of the company, to operate. We want to make an income. So that is the definition of income as a first element that I'm explaining now. So this income, which is monies that the company generates through the operation, you must understand that this income, it have got a rule under accounting. What is the rule of income? The rule is that you must know what is the impact of the debit under income, what is the impact of the credit under income. So the rule of income, students, is that all incomes of the company, they increase on the credit and they decrease on the debit side. So meaning that each and everything that you know is an income, it means that for it to increase, we must credit it. For it to decrease, we must debit it. This simply means that it will complete us what we call what? A double entry rule. Are we all together? So very much important. You understand what is an element called income, and after that you understand its rule, where it increases and where it decreases. Because in accounting, we are going to work in terms of the debit and what? And credit. So after you know this rule, you must know what are the incomes. What are the examples of the incomes that the company might have? Remember, incomes of the businesses will differ depending on the nature of the business. The income of hardware cannot be the same as the income of the university, cannot be as the incomes of Pick n Pay. You understand? So the incomes depend on the nature of the what? On the nature of the business. This simply means that, e.g., the first thing that we can have is what? Is sales. Are we all together? Sales, we are referring for the businesses that are selling things such as Spar, such as Pick n Pay, Mr. Price, and others. So when they sell, if you are selling something called goods, Toyota is selling cars, those are regarded as what? Their incomes regarded as what? As sales. I'm sure you are following that. So sales is an income. So if you come across the sales on the transaction, know that the sales is what? Is an income. And then we have such as fee income, which others they classify is as a service rendered. Service rendered. So fee income and service rendered seems to be the same thing. Why? So the fees as an income are charged by the businesses that are rendering services. Businesses that offer services. So it means that if you are a law firm, you render the service to your clients, you charge them what? A fee income. Or you regard that income as a what? As a service rendered. Are we all together? So it means that each and every company that render the service, they don't say they have sales. They say they have the fee income or they have what? Service rendered. Are we all together, right? That was example number 2. We also have what we call discount received. Discount received is what? Is an income. Why is an income? Discount received is that situation where the businesses are buying from suppliers and they stand a chance to get a discount. So the money that we are willing to spend on that particular thing that we want to buy or that particular service that we want from that supplier, then they discounted it. It means that that discount is an income to the company. We are all together. We have what we call a bad debts recovered. A bad debts recovered is also an income. Bad debts recovered is also an income. So bad debts recovered is the money that we have recovered from the clients that have run away with our money, which we have already written off as irrecoverable, as a bad debt, as an expense. But now they have paid, meaning that it's a bad debt that have not have been recovered. I'm sure you are following that. We have something like interest income. We have something like rent income. We have something, what else that we have? Trading stock surplus. Trading stock surplus. So even the trading stock surplus is an income. We also have the commission income. It's regarded as an income. And then we also have what we call a profit on sales of assets. We have things such as provision for bad debts decrease or provision for doubtful debts decrease. So it's the same thing. So that is an income to our company. So I'm sure now you are following. This is the first element in our first episode. So please have a note when you watch this video and make sure that you define, you give the example, you understand the rules. See you when we address expense on episode number 2. Don't forget to like, share, and subscribe. See you next time.